But I think what we will see, and again, this is kind of critical to this DeFi narrative that's emerging on Ethereum, is people want exposure to every different type of asset class on Ethereum. And the reason why is because you turn these asset classes from, just a spot BTC token that you're holding that, can't be connected into these other platforms into all of a sudden this thing that can be composed into, lending platforms, and you can create automatic trading sets, and there's all these different things that you can do with these assets once you've kind of sucked them into Ethereum and they're on Ethereum.
All right, guys, it's that time of the week again. We have another episode. We have another great guest. Man, this has been a great run that we've had over the past 2 weeks. So we appreciate everyone that's been following along. But we have Synthetix Exchange platform, and we have Kain Warwick on today. So I do want to kick it over to Kain here shortly, but I want to get the dynamic duo introduction from Dimitri. Dimitri, what's up, man?
Yeah, no, I'm super excited. Been following these guys for quite some time. So, and, given my background, I'd love to dive into, the questions that we have to discuss, about Synthetix and, their platform, how they've been evolving overall and what they have in store for us. So,
yeah, absolutely. It's going to be a really cool episode because I think you're going to attack it from your experience on Wall Street and Forex, and I'm going to kind of attack it from an investor standpoint. And I think we're going to be able to mix those two together correctly. Maybe it turns out to be a shit show, maybe it doesn't, but I'll be over here listening while you guys riff and go in depth. But Kain, we've gone long enough without introducing you. How are you doing today, Kain?
Yeah, good. Thanks for having me, guys. I think in our sort of pre-discussion, it sounds like it's going to be a very, very interesting hour or maybe more, depending on how deep we go, right? So looking forward to it.
Yeah, you gave us a 2-hour hard stop, so you're going to be here the whole time. But hey, before we go in depth on Synthetix and have those deep discussions, you are somewhat of a Renaissance man. You've written a book, you've been in a band, you've created all these different companies, and I don't want to fluff you up too much here, but kind of give us the background of how you found yourself, not in crypto, but just in tech, and then on that run up through Haven, and how you actually got to Synthetix.
Yeah, I mean, obviously, if you've looked at my LinkedIn, it's a bit of a mess, right? It's all over the place. There's all kinds of stuff going on there. So, when I was in high school in Australia, we have kind of a different approach to how you go into university. So finish high school, and then you kind of turn up, and like, I grew up in the States, right? So like my kind of expectation of how college worked was like very much formed from like US colleges, right? Like turn up, you get a couple of years to just kind of screw around, and then like maybe you focus on something eventually, right? And the day that I turned up at university, obviously I hadn't done my research very clearly. They were kind of like, okay, so like what is your major that you're going to specialize in? And I was like, I don't know. I mean, what, like,
beer?
Okay. Yeah, exactly. And so I was like, I guess like genetics, right? And so, I started studying genetics, and I'm terrible at organic chemistry. It's like the worst subject in the world. I hate it. It's just like the most boring, dry thing. I'm sure all the organic chemists watching are up in arms, or maybe one of them. But yeah, so it's kind of a terrible thing. And so I got like 2 years into this degree, and I found a lot of it really interesting, but some of it just terrible. And I was like, this is probably not for me. And a friend of mine was in the US and had moved up to Seattle to work at the startup. And he was like, hey, we're trying to like find some people to come and work. And so I like went and worked at this startup, and this is early 2000s, right? So it was like right before the crash. And I've been following tech for a really long time, and I was like, sounds exciting, much better than what I'm doing now. So I moved to the US to like go and join the startup. And I think within like 6 months, the crash kind of happened. They struggled to raise money. We kept it on life support for a while, but like even in spite of how bad that experience was, like there was a part of me that was like, okay, startups are my thing. And so that's kind of been the continuous thread since then, in the last like 20 years, where like wherever a startup opportunity has kind of been available to me, I've sort of jumped at it. So.
Yeah, what are some of the differences that you can kind of pinpoint between the kind of Australian ecosystem within crypto and the US? Because we have a ton of guests from all over the world. Love to know like what actually goes on down in Australia as far as cryptocurrency is concerned.
I mean, it's one of the biggest crypto markets in the world, right? It's a little like Korea, right, where it's its own little bubble. It's kind of detached from everything else. But at various times, through like 2016 through to early 2018, it was maybe in the top 5 in terms of crypto activity. So a lot of excitement in crypto, Australia from retail people. Maybe that's because we're a country of degenerate gamblers. I don't know, but it was definitely a thing that there was like palpable awareness of, and so there were a lot of exchanges that popped up, from as way back as like 2012, 2013, and so Blue Shift, which is a company that I founded before this, basically facilitated getting cash into these exchanges, right? It was like an on-ramp amongst other things. And so, I made friends with some of the exchanges and got to know those guys, and, had obviously been following crypto for a while. But it was like 2014, 2015 when we started working with them. And, that kind of really sent me down the crypto rabbit hole, I think. And it's how I ended up here.
Nice. What do you see overall, like the regulations are like in Australia as far as crypto goes? We've been kind of struggling to catch up in the US here. We've been kind of taking back seat a little bit, but they're progressing lately a little bit. But like, overall, how do you how would you compare the Australian regulators, maybe to like US?
I guess it depends on what the sort of category is, right? Like if we're talking about permissiveness in terms of innovation and ability to kind of let things play out, like interestingly, they've been pretty open. I think the regulators here have done a really good job of kind of a bit like Singapore, right? They've been pretty hands off and said as long as you're not outright defrauding people, as long as you're operating within the spirit of the law and you're trying to do the right thing and building a startup, they're kind of okay with it. Where they've been a little harsher and a bit more, draconian, I think, is in some of the ways that they've handled like tax. So, there were issues, in the early days with, how they treated crypto with like our VAT, our GST tax, which was quite problematic. And they've been a little bit harsher with, things like KYC regulation and stuff. So the exchanges, I think, have had a harder time. But, crypto startups have been, pretty well left alone and kind of supported. So it's been good.
Nice. Yeah. That's always good to hear. Go ahead, Q. Sorry.
Yeah. I was going to ask, so how did you find yourself, founding, I don't know if I think you said Blue Shift in how you've made that into Haven and then how that founded into Synthetix. And I would love to hear that story of how you kind of found yourself dealing with fiat on-ramps as well as just fiat stablecoins in general.
Yeah, so Blue Shift is like a independent entity, right? It's a private company, for-profit entity. It's got a bunch of investors and stuff, and it still operates. So it that was kind of, I guess, how I got into crypto, but it's a totally separate sort of stream to what we're doing or what we started with Haven. Haven kind of came out of this idea that you needed the thing I mentioned about Korea is kind of part of this as well, because Australia didn't have a crypto mining industry, similar to Korea. Any crypto that you wanted had to be imported essentially, right? So it was all net imports, right? And so the spread to get crypto into Australia, through like 2016, 2017, just crept up and crept up and crept up. And we kind of looked at that and said, like, okay, there has to be a better way to bridge this gap. And obviously, coming from the FX space, Dimitri kind of gets how this can be, problematic. And so this idea that, USDT was sort of insufficient and high risk, and, that people weren't going to be willing to kind of hold big chunks of it to kind of bridge these gaps was problematic, right? Obviously, DAI hadn't launched. And so I had a view at the time that, I guess a permissionless stablecoin that was crypto collateralized would be a much better approach than, say, dumping a bunch of fiat in a bank and creating an IOU. But then in reality, what happened was all these regulated stablecoins launched and, kind of killed that use case, which is what forced us to pivot Haven away from like that pure stablecoin use case towards more generalized synthetic asset platform.
Nice. Yeah. I actually hear a lot about Latin America where, the demand is there for crypto from just regular people, but the access to liquidity in the market fair prices is not available. And therefore, they end up paying really crazy spreads on these conversions,
Yeah.
and people would just literally, would offer that liquidity and offset it with US where, and bank on that spread, which is, kind of unfair, if you would say. So that issue is like all over the world, and especially in countries where, they need that stuff, right? Where they have economic hardship and so on, right? They need the liquidity and access to fair market prices, which will essentially push the demand for Bitcoin and crypto further, because those are the people actually need it. So that's super fascinating that you found that, issue and essentially created a solution, even though, it was kind of a temporary market fit at that time. So that's super cool. So you started Synthetix, right? So let's jump into that because I can't hold anymore. But, I really want to talk about what you guys are doing there. So Synthetix is essentially a derivative, right? From what we understand, from the actual crypto assets, and then you guys also offer, a couple stocks and commodities, some FX pairs as well. There's two tokens that are important there that I wanted to kind of go over. There's SNX, right, and there's Synth, right? Two tokens. So what can you kind of briefly talk about like what's one needed for what purpose on that platform?
Yeah. So SNX acts as the collateral essentially, right? So where you might have like a futures trading platform or derivatives platform like BitMEX, where Bitcoin is a collateral, that allows all these contracts to be created. In our ecosystem, within our protocol, SNX is the asset, and that's important because while SNX is not necessarily the best collateral in the world right now, the intent is that over time, SNX, because it accrues the value from the activity that happens on the exchange, because all of trading fees that are generated are paid SNX holders for providing the service, for providing collateral. Over time, the collateral sort of stability will increase, as the exchange grows and as the yield from that asset grows. So that's kind of the critical thing to get, I guess, is that design decision is there in the early days to ensure that eventually the long-term alignment kind of converges, right? And you've got this stable asset. But right now, it's not the best asset in the world. Obviously, you could use Bitcoin or ETH. They're much better collateral than SNX is right now.
Yeah, no, absolutely. I mean, any token that starts out right away, there's the liquidity issue, and there's the volatility that comes with it, with that token as well. Using that as a collateral, if you look at the SNX volatility and compare that to volatility of Bitcoin or Ethereum, it's different. But like you mentioned, later on, that's looking to smooth out and be more stable, which I completely understand. In terms of fees, so this fee that you mentioned, and that you're charging, right? So what is that fee, and will that fluctuate as well if you have more demand, or is that kind of stable, fixed at the same time, where it's going to remain the way it is?
Yeah, so I guess before going into fees, right? There's SNX, which is the collateral, and then there's all of the synths, right? That that have been generated against that collateral, right? Again, to use the BitMEX example, the equivalent of like all these futures contracts or derivatives contracts that have been created against this pool of collateral. So we've got synthetic fiat currencies, synthetic cryptocurrencies, synthetic indexes. We don't have stocks yet, or ETFs, or other things. So at the moment, there's a standard trading fee, which is 50 bips on all exchanges between these synthetic assets. And then there's a 1% fee, so it's twice as much if you go from an inverse asset So we've got these inverse tracking assets like inverse Bitcoin, inverse, Ethereum, that, is there to basically stop people from using that to get additional leverage, essentially. So, so if you go, directly from a long asset to a long position to a short position, you pay 1%. If you go from, SUSD, a neutral asset, if you will, to, a short asset, you pay 50 bips. So.
Wow. Yeah. That's fascinating. Q, you had a question?
No, I mean, I'm going to try to stay out of your guys' way here, but just from like an uninitiated perspective, what is the importance of having synthetic USD and synthetic Bitcoin and all of these different derivatives on this exchange platform? Why do you think you found success so quickly with a user base? Because, over the past, 6 months, Synthetix has really seen a strong case for like a user base as well as volume. So I'd love to know, like, why was this something that was so needed in the market?
So I think it is worth also sort of clarifying that, at the moment, as it stands, we actually don't have that much demand, right? The volume, the organic volume, so we can get into this a little bit later around organic volume versus, kind of adverse selection that we've been dealing with over the last, 6 months. But the organic volume is somewhere between like 500 grand and 2 million a day, right? Which is good for a DEX, right? It's not terrible. What we've seen in terms of, let's call it adverse volume, right? A volume that's been kind of not ideal for the platform has been up to 20 or 30 million dollars a day, right? And so this is the volume that we've been working on, kind of reducing, right? By closing some of the existing loopholes and gaps and exploits that exist in the system. So this is still a system that's very much kind of being developed, right? It's build an airplane as you fall off a cliff style, approach, right? So we're not done yet. We haven't even really gone out and started to try and generate that organic volume from traders. So a lot of the trading activity is coming from people that are holding the SNX token, that are kind of dog fooding the platform. But I guess where you have seen the excitement grow, I guess, is not necessarily from the actual adoption, but from the potential adoption. People are starting to see that Ethereum as a platform is kind of this like financial black hole, and basically anything that gets close to it that's a financial instrument of any kind just gets sucked into it, right? So you look at stable coins, all the stable coins have been sucked into it. Derivatives are all being, sucked into it. You're starting to see these synthetic asset platforms and things like that. Lending, it's like all of this stuff is just coming onto Ethereum, and as more of these platforms are built, and as more of these different types of assets and asset classes come onto Ethereum, you get these really powerful network effects. So I think people are seeing that DeFi emergence, if you will, and that's creating a lot of excitement. But I don't want to sort of imply that we've had any great success yet, right? We're still like super early.
I'm glad you made that distinction between the volume, the real volume that you guys identified, and then the one that's kind of staying within the platform. A lot of exchanges that will stay away from it, and they'll report one number, but really the other number is different. So I really appreciate that honesty and transparency right off the bat. So my question is, really when I'm looking at these derivatives and the Synthetix, like, why would somebody trade, let's say that derivative instead of, like spot or, futures, let's say?
Yeah, I think it's a good point, right? Yeah. And there's right now, not really a strong use case for it, right? Like, why would you trade, BTC on Synthetix versus, just trading on spot or futures market or whatever. But I think what we will see, and again, this is kind of critical to this DeFi narrative that's emerging on Ethereum, is people want exposure to every different type of asset class on Ethereum. And the reason why is because you turn these asset classes from, just a spot BTC token that you're holding that can't be connected into these other platforms into all of a sudden this thing that can be composed into lending platforms, and you can create automatic trading sets, and there's all these different things that you can do with these assets once you've kind of sucked them into Ethereum and they're on Ethereum. So things like token sets, for example, where you've got these automatic rebalancing platforms, right? If you don't have BTC on there, or you don't have a way of getting exposure to BTC, then it makes it really hard for you to kind of implement that and bring people on. So that's one of the reasons that I think in the future, that composability value proposition will just get larger and larger and larger as people build different, solutions and platforms onto Ethereum.
You mentioned something, listened to some previous interviews in terms of slippage and stuff. You guys really focus on minimizing slippage when doing executions for these trades on your derivative. Is that has been the focus so far, right? And it's fascinating that actually coming from FX, slippage is a huge thing and nobody's talking about it, right? In retail market, in FX, they're like, I remember when I was working for FXCM, they're like, what is the slippage, that I'm going to experience in your platform? And that was a really big deal and deciding factor in terms of choosing the broker, because brokers were found to, slip you a lot on certain trades and so on, right?
I know the game. Yeah, exactly. Yeah.
Yeah, exactly. So, and in crypto, nobody's really talking about it yet, right? So it's fascinating, to not see that narrative be as big as an FX right now, and even given the fact that Forex is the biggest market, right, the most liquid, and yet they still talk about slippage there, right? So. But in crypto, nobody is really focusing on that yet. Are you seeing that, maybe the shift is going to start happening where people are going to start, focusing on the execution quality when they're executing these orders and minimizing slippage when they do these trades? Is that kind of the
you would hope so, right? Like in an efficient market, people should be talking about these problems, but crypto is still super inefficient, right? So we're still, I posted a tweet the other day where I went onto CoinMarketCap and sorted by the adjusted volume number or whatever, and every single exchange that was on there, I was like, this is just nonsense. What am I even looking at, right? And then but that said, now they've got another metric which is tracks liquidity, right? Which is obviously still going to be imperfect, but when you actually sort by liquidity, you start to get a better reflection of what we all know as traders on different platforms, the actual liquidity that's there, right? So I think this problem of having volume, in the early days as a proxy for liquidity, was just a way for people to just game things, right? Now, as you can obviously game liquidity as well, and you can spoof liquidity and stuff. So I think that game will shift, but then eventually, slowly, we should edge towards something where it's the actual execution cost, the all-in execution cost of a trade that people are looking for. But we're just not even close to there yet. We're so far away from that. It's yeah.
It's interesting that you talk about gaming liquidity, because you guys aren't gaming liquidity on Synthetix, but you're kind of incentivizing it, right, through this SNX token. Kind of take me through the user experience there of if I want to get involved in SNX and I want to stake SNX to get this synth, what then would I do with the synth and go on from a user experience there?
Yeah, I mean, at the current stage as it stands now, right, there's a lot of overlap between traders and people providing this service, right? But what ideally we want to see over time is that the vast majority, 99.9% of people that are trading on Synthetix Exchange don't need to understand how SNX works, right? The people who are holding SNX are providing a service, right? In the same way that a broker provides a service, right? When a retail trader turns up to use a platform, all they care about are the stats, right? What's the slippage? What's my execution cost? What's the all-in cost? They don't care about, how are you handling flow, and it should be abstracted away from them, right? That complexity is not really something that they should care about. So ultimately, you should have these two different sides of the system. You should have SNX holders who are staking and providing a service, right? And maybe they're staking themselves, or maybe they're delegating, or maybe they're using some kind of staking service or whatever eventually. And then you've got traders who just turn up and say, this is the best place for me to execute my trade on, synthetic whatever maker, or synthetic BNB or something like that. And I like it because not only can I trade synthetic crypto assets, but I've got all of these other exotic assets like indexes, and I've got mixed hybrid equity crypto indexes, and I've got all these different instruments that I've got access to on a single platform, and that's all I care about, So I pay low fees, low slippage. I've got access to a whole bunch of assets, and I don't need the underlying asset. I just want synthetic exposure to the price itself. And so those people will just come and trade. They'll never hold SNX. They won't care about it. It's totally irrelevant to them. They'll just be using the platform. And then on the other side, you got the people providing the service, and that's the hard thing. That's the hard job to kind of do.
Well, what is your strategy there, in terms of attracting these people to provide these, staking services and so on? Have you talked to any, pools or entities that are looking to do that on your platform to increase that, to provide that good experience for those, retail folks that want to trade it, without really worrying about, what's happening in the background, like you explained?
Yeah, I mean, obviously the staking ecosystem, even within crypto, is very immature as well, right? And we've seen the staking fees and yields and all these things kind of collapse and converge towards zero, over the last 12 months. So I think, I read an article the other day where there's several hundred staking services, that have either not been able to raise money or not attract customers or have kind of folded. And then you've got what I think is really interesting as this plays out, where you've got the spot markets, right? The Binances of the world, the OKXs and all of these other huge spot exchanges that are providing staking services, right? Because they've got the assets in custody, and it's easy for them to offer that, and it's just an added service, right? And really what they want is the trading volume. So it is an interesting dynamic to kind of watch that play out, because it may be problematic for us in the future, if we're attracting volume away from these exchanges. That said, these exchanges also have the possibility of, providing flow to Synthetix, right? And listing the asset and, adding an incremental fee on top of the protocol fee and just integrating into their total offering, right? So there's a whole bunch of different ways that this could kind of play out over the next, 2 to 3 years, but it's really hard right now, given how immature all of this infrastructure is, to kind of know which path it's going to go down. And we just have to be as flexible as possible and be ready to kind of move with it.
Yeah, absolutely. And a lot of these, staking services, or different networks that offer staking and give you a yield, right? But you're still exposed to the price volatility of that asset, right, that you're staking. So in some cases, you have the tokens that fall so much that the yield doesn't really compensate for it, right? So that's so fascinating to see what you describe. It's kind of immature in that sense, because really what you would want to have is maybe a tool or the ability to hedge away the market price volatility from that token, and being able to capitalize on that staking percentage that you get in yearly. We haven't really seen something like this come out in the market just yet, but you could kind of do it manually or not. So you guys think you might be releasing a tool that might be similar to it, or be addressing that issue, or what are your thoughts about it?
It's an interesting question, right? If staking yields are high, right, but you're exposed to the underlying asset volatility, and then someone builds a service to hedge against that volatility, then just by definition, you expect, as the market becomes more efficient, the staking yield collapses, right? The borrow cost or carry cost of holding the underlying asset all of a sudden goes up, because you've got this efficient market for borrowing it or hedging it. So again, I think we're just in such an immature market that these inefficiencies are huge, and I think it's easy for someone even the size of Binance to come and kind of exploit that inefficiency and get a lot of yield. And I don't see this really shifting in even the next 12 to 18 months. I feel like there's still going to be this opportunity there, but certainly for the average retail person, and you look at some of the fees that are being charged for these staking services, 25% or whatever, right? As the average retail person with 20 grand in assets or something that wants to try and absolutely maximize the yield, there's just opportunities everywhere, right? If you're willing to go down the rabbit hole and really kind of dive deep into what the best way for you to do it, you could absolutely set something like that up yourself and get a yield of 20% or something like that on these assets.
So yeah, I guess what you have when you connect to platforms like Staked is you start to have people who aren't actually invested in those networks, where you're trying to have a stake in that network. So when you connect those to those platforms, you have people who are now own stake in the platform, and are just moving all the time. Like there's even robo advisors that have come out, in the past 6 months, where they're able to move your assets on a daily, on a rolling basis. So how does that destroy kind of the security of those networks?
Yeah, I think it's problematic, right? There's definitely some uncertainty, I guess, right, around what does this look like as it plays out over the next 12 to 18 months, right? And I think as the market becomes more efficient, we will see that some of these things that maybe from a security perspective are viable now because the market's inefficient. Once the market wises up and starts to understand how to exploit these opportunities, anything in crypto that's exploitable will be exploited. It's just a matter of time, right? And so I think you will see some of these things that right now are kind of skating on thin ice and just flying under the radar or whatever, will start to be targeted, and people will really extract value out of them. So it's hard to say exactly how that plays out, but for smaller networks, I think it's going to be really, really hard to grow. So, even the transition for ETH to proof of stake, right? I think there's a lot of risk there, and some people just kind of go, oh, it's not priced in or whatever, right? Whatever that means in the crypto network, having something priced in. But like they sit there and say like, oh, it's not, it's not priced in. Like once we move to proof of stake, it's going to be amazing, right? And it's like, well, like it's actually massive tail risk, right? Like we don't really know what that looks like. We don't know what the infrastructure, will need to be for that to play out. I'm pretty bullish on it, I think, but there's tons of uncertainty. It's uncertainty all the way down.
Yeah, absolutely. And our market is saturated by speculation, and those speculations tend to outrun expectations quickly, especially when the products are delivered and so on, right? We're well over speculated on that asset already once the product is out.
Yeah.
So I completely agree with you. I think Q, you were talking about staking. I know we kind of went into that staking rabbit hole a little bit there, but also another point about it is that you mentioned, I think on Twitter, Q, that you have the situations where certain stakeholders where they have rights in terms of voting and so on, and deciding on certain changes on the platform and whatnot. But then you have all these like zombie like stakers, like not zombie, but like Binance or exchanges, right? That they're just like holding the majority of it, right? But they don't really care about like what's going on and how the network is going to advance, right? So now they're becoming these zombie politicians and not doing the right stuff, right? Like stake kind of too, right? They're just there for yield, right? They don't care really about making changes in governance, right? I think Q, that's kind of what you were trying to talk about as well, right?
Yeah, definitely. I think like when you create a network and everyone's going through this, and we can dive deep into this, but we've talked about that Pareto distribution for a long time, and when you have a network, most of those nodes, if there's any type of governance that goes on, most of it's being done by a small amount of people, and the rest are just there for the yield, like you're talking about. So, and that goes with distribution of tokens as well. But Kain, before we talked today, or before we went going live, you were saying that you've done a ton of these interviews, and we've got kind of like gone in depth here. But like, what is something that maybe you would love to talk about that you haven't talked about on all of your interviews? Because you said you've done so many, you've done 10, 20 of these. I watch you did a good job. But what is something that like you haven't been asked that you would love to like go into deep dives on?
Well, I mean, I think this kind of area, right, is actually important because, even though we're not a proof of stake network in the sense of, validators that are confirming transactions, we require active stakers, in order for the network to be stable, right? The idea is that people who are staking SNX have a role to play, which is to hedge their exposure to the asset pool, right? There's this pool of undifferentiated assets, and people can come in and take different positions, and you are sort of obligated as an SNX holder to, maintain a hedged position against this pool, right? Now, there's a few ways you can do it. Most people do it by kind of sitting in the pool and trying to match the pool, but that's somewhat self-referential and problematic, right? Ideally, what you want to do, and this is where the end state we want to get to, is you turn up and you say, I'm going to provide this service, I'm gonna provide this collateral for this network, right? And you lock your SNX and you mint synthetic debt and you sell that to traders, right? And you say, okay, traders, like, go nuts, right? Start trading. What the proceeds of that, right? Like, so you sell that debt and now you've got this proceeds. Now you can just sit there, do nothing, right? And the pool's moving around and potentially there's issues. Or you can take the proceeds of selling that debt and you can go out and hedge in the spot market equities, for example, right? So, look at Tesla, right? Over the last, 2 weeks, right? Let's say we had a synthetic, Tesla asset, right? And it made up 10% of the pool. If you were sitting there and effectively not hedged against that going up or down, right? Then you're kind of, in this case, essentially short Tesla as it's running up, right? And so what we would sort of say is that ideally you want SNX holders who have a level of sophistication to be able to go out into the equity spot market or the futures market or whatever and say, as that percentage of the synthetic pool is growing, in more people going into Tesla piling in, that's okay as long as we're hedged over here, right? As long as this part of the network is hedged, because then when those people go to cash out, you'll be able to buy your debt back. So essentially what you want to be able to do is have all these people that are going in and out of synthetic Tesla positions, right? You're getting the fees from it, but at no point are you sort of net short or net long. You're just kind of neutral to this debt pool, and you're essentially getting the fees from that activity. Now, to do that and do that well is hard, right? Like, that's not a trivial exercise, and particularly I think Dimitri gets that, right? Like, it's not even Forex where you've got like the G10 currencies. Like, you're talking now like every asset class or whatever. And so this is something that I think in the long term, the project that we really need to kind of understand, is this even achievable for someone to be able to hedge their exposure, and how accurately can they hedge? But ultimately it is a somewhat of a zero-sum game, right? The better you hedge, the more of the fees you'll get after factoring in hedging costs in the spot markets or futures markets. So ultimately I think we almost need to see professional stakers and staking services coming in and competing with each other, because I don't see a reality where like the average Joe can turn up and be able to hedge as well as some large institutional, and that's kind of okay, right? Because it's still an open market. Anyone can come in, anyone can stake. There's no permissioned aspect to it, right? So that's kind of the future state that I think we can maybe even dig into a little bit, and how that might evolve and how we get there, because we're obviously not there yet, right?
Yeah, and when you're talking about that, like average Joe, he just wants the the functionality of the platform without thinking in the back of how things are working with with stakers and providing that collateral to the system. And it's interesting right now that we have in crypto, we have more kind of hedging tools rolling out. We have options rolling out. We have futures and so on that give more flexibility to those people that want to hedge their exposure. In some cases, maybe they don't want to, even hedge the exposure if they see an opportunity in the market. We know that very, very well, right?
Yeah.
But that's already going to be managed by the desk, basically, and managing the book there and making the bets on that end. So I completely agree. With what you said. We need that sophistication in that side. That maybe we have traditional finance that they're doing right now to be in crypto and be able to adapt to how crypto is working and be able to offer those products, to offer the hedging tool to it. You obviously have your bread and butter is the Oracle, right? That you guys are using, right? To pull the pricing and give it to the traders to execute on. How do you guys derive this price? How many exchanges are you guys connected to? Where do you get your pricing from? Because obviously traders will want to see the most competitive, like bid and ask, right? When they're executing their orders, and if bid and ask is not competitive, then that's undermining the traders, and goes down in the hole with the execution issues and so on. So how many are you guys working with right now? If you can disclose them or not, or not, but what do you get in the pricing?
Yeah, so I actually did an interview with Sergey from Chainlink like a week ago or something like that. So we kind of went pretty deep into this this kind of aspect. But what's interesting is when we started, there weren't oracles, right? There, we had to build our own centralized oracle, right? Which for a decentralized system, is kind of problematic, right? And not only was it problematic in the sense that it made the system more centralized, it also was less robust than a decentralized oracle network. And so we've made a decision, maybe almost a year ago now, to transition to Chainlink, and that transition's kind of halfway done. So we've moved all of our Forex feeds over to Chainlink. They've got a network of node operators that pull data, from a bunch of APIs. I'm sure you would know, most of the Forex, APIs, and so they all pull that data down. They then, essentially aggregate it and publish it on chain. And so there's this kind of fairly sophisticated mechanism to ensure that the prices are kind of medianized and you get a true reflection on chain of what the spot price is. One of the challenges though is obviously you have latency. So Ethereum obviously is much higher latency than if you're using a centralized service. So there can be lag between prices. For Forex, it's not too bad, especially when you don't have leverage. But you start introducing 100x leverage, and that latency can become problematic, for example. So this is something that I think eventually we'll move away from, in the next month or two, we'll move away from centralized oracles, and we will basically hand over all of the ownership of publishing these prices to the Chainlink, decentralized oracle network, which will be a huge burden off us and a huge aspect of kind of centralization that's removed from the system. But then it does create some interesting dynamics where, if we want prices for, weird things, right? Like let's say we need a Palladium price, right? Then we need to go out to this network of Chainlink operators rather than us just, going and finding an API provider and plugging it in. We need to actually go and say, okay, guys, we need you to start publishing this price. There's some kind of negotiation. So how do two decentralized networks come to some agreement about what we publish, and that comes
set
down
up
to
a
DAO. Exactly. And so then it comes down to like a governance question, right? Like, okay, so we as the collective Synthetix protocol are now requesting from the Chainlink protocol this thing, right? And both of these projects are still fairly centralized, so that negotiation can kind of work fairly well. But what does it look like in 5 years? I don't know. It's two DAOs talking to each other saying like, hey, can you do this for us? And the negotiations become super interesting because it's all transparent and on chain, right? It's like we publish a request, then they publish a proposal, and then there's a counter proposal, and everyone can literally see what's going on. Now maybe we get to a point where we've got ZK zero knowledge proofs or whatever, and we can hide that negotiation from being published on chain. But ultimately, as a DAO, anyone who's a DAO member will have access to the data. So there's all kinds of crazy things when you start looking, down the down the track about what does a negotiation for price feeds look like.
So previously and up to this point, what is the governance process like right now? Are the stakers actually involved? Is it just kind of within Synthetix team that's making these decisions? How are the stakers involved in the governance process now, and like you said, in 6 months?
Yeah, so as it stands now, the project was started off obviously with a core team, right? And we saw ourselves as, I guess, the custodians of the project, and we're kind of trying to implement this proposal for a stablecoin network, a payment network, right? And then as we pivoted away from that, one of the things that we obviously realized is that there's this trade-off between the flexibility of a team to be able to execute as a startup and buy-in from a community. And so you've got to really thread that needle and find a balance there. And I think we're moving slowly towards a more community governed framework. We're not ready, and I think the community has pretty strong consensus around this, that on-chain voting of some kind right now would be the wrong approach. And so we have a very kind of rough consensus view where we just argue and yell at each other in Discord until people kind of capitulate and go, okay, fine, do it. So we had as just a practical example or a concrete example, we've obviously had this front running issue. We've come up with a solution, which is fairly technical, but let's assume that that solution is going to work, right? So as a front runner who's been, doing this front running activity for the last, 6 months, and essentially they're just exploiting the Oracle latency to kind of skim a little bit off the top, right, of the network, right? Now, a little bit at times was, maybe a couple grand a day. At its peak, it got up to like, 60 grand a day or something like that, that these guys were kind of pulling out of the network. And that's coming directly out of stakers, right? Because that's, net losses for those stakers. So anyway, we got to this point where it's like, okay, hey, we've announced we're going to close this loophole, right? So the game theory there as a staker, where there's no penalty as a front runner, where there's no penalty, is obviously you accelerate, right? Like you
Right.
just try and extract as much value as you possibly can before the door's closed, right? And so, it kind of escalated. And then we got to a point over the last couple of days where we're like, okay, it's gone from, 5 to 10 million a day in kind of front running volume to 20. And then it got up to like $40 million in a day, right? And, they were fairly profitable because volatility obviously makes them more profitable. And so as a community, we started discussing like, what are the options, right? And the immediate option to me, and I think to some of the other people in the community, was let's just raise fees. We've done that in the past, right? We've gone from 30 basis points to 50 basis points, and that reduced the impact of front running because it just made it harder for them to make money after fees by, exploiting this latency. And so, kind of a dumb, I guess, obvious solution is just raise fees. Like, let's raise the fees to, 100 basis points, make it 1%, right? And some people were like, that sounds like not a great solution, right? You're basically saying, we're kind of accepting that this is not a trading platform that the average trader can now trade on, right? Because your all-in cost is going to be 2% round trip plus getting into the system and out of the system. Like, you're talking about 2-3%, right? It's not like you're shaking your head like, what?
No.
Right? And so so then it was like, okay, well, what are the alternatives, right? And one of the alternatives was, let's actually disable for the moment, temporarily, some of these more volatile assets like XTZ, right, and BNB, and even Litecoin, etc. And so we looked at the volatility over time, and there was a community member who was like, this fee raising thing is just madness. Like, we can't do it. And so he wrote a proposal. So we have this process where anyone in the community can write a proposal, called it a Synthetix proposal. He basically wrote this proposal and said, let's shut these things down, leave the fees as it is. And the community kind of talked it through and yelled at each other for a while. And then we were like, actually, that's a much better solution. And so last night, we basically shut down these assets while we wait for this fee reclamation solution to go live. And the volume, I haven't looked at it for an hour, so it could have jumped up, but the volume dropped from like 40 million a couple of days ago to like back to like 2 or 3 million. So a lot more of that's organic, right? Like, the front running volume has dropped. So it was effective. It was kind of a blunt instrument, but at times when you're in the process of trying to solve these problems, you got to use a blunt instrument. But it was probably not as blunt as like raise the fees to the point of being unusable. So I think the end result was, it was a good negotiation amongst the entire community to kind of find that solution. If it were up to a core team, we probably would have just raised the fees, which would have been the wrong decision, right? So at times it can work out, and through that consensus process can get to the better outcome, I think.
Yeah, it's super interesting because we had a similar experience in Forex as well. So we had basically traders that were capitalizing on latency or price feed, and around, maybe around specific news events, when volatility picks up, they'll front run it because they'll get a reading that's faster than what your broker is providing. And, brokers, they'll provide the pricing, you hit the execution button, basically they have to be, give you that price. That's the whole value behind it. And, we did experience that, we did have, these front runners, pickers, predatory trading, basically in FX. But, in FX, it was kind of easy because, when we did find those accounts, we're like, okay, cool, we're just going to increase your spread. That's good luck, good luck picking us now, but like here, for SNX, it's crazy because like you can't really do that per account, right? So you have to. So basically, because these predatory trading is happening on your platform, because of those couple bad actors, the whole infrastructure gets impacted. And you debated, if you wanted to raise the fees for everybody, basically just because of bad actors, right? Which is crazy because like that is so unfair, right? So I really like the, the way you guys went about it, and start, kind of closing down that loop. So right now, so right now you did minimize it, right? So you're seeing some effects, that are based on your decision. You're seeing less of that predatory trading, people doing this type of stuff on your platform, or you still need to gather the results post your.
Yeah, I mean, it's been 12 hours or something like that since we removed those volatile assets, but it has dropped pretty quickly. And you can see these accounts, right? We know the wallets, right? There's like 5 or 6 wallets that are doing this. Unfortunately, in crypto, you've got Sybil attacks, right? So as soon as you go, okay, there's no KYC, right? So it's not like we can be like, hey, the person behind this wallet now, has a spread of 50 bips instead of 30 bips or whatever, right? And then if you do that, they're like, okay, I'll just spin up another wallet, right? And I'll, go and start the process again. So essentially you have to close it for everyone, which makes the job just that much harder than a centralized service, right? It's just one of the fundamental challenges, and that's where I kind of made that point. Like anything that is exploitable in crypto will be exploited. And even to the point where we had this incident, and I'm not sure if I've talked about this on another podcast, certainly haven't gone into it as much depth, and I'm sure, you might have a perspective on this from your Forex trading experience, but we're a derivatives platform. We have a maker derivative, right? So the maker DAO token, we disabled that as well because there was not enough liquidity in the spot market. And what was really interesting is when we listed Maker, there were several centralized exchanges that were supporting the Maker token, right? And there was a decent chunk of liquidity there, but they were also in Uniswap, right, which is this automatic market maker, pooled trading platform, right? And the interesting thing about the implications of most of the liquidity of a token being in one of these auto market makers is that essentially any trade is deterministic. So yes, you've got this deterministic trading, because it's not going to move away from you, right? It's just a sitting duck, this pool of liquidity, right? And so some smart person was like, well, hang on a second. If most of the liquidity is happening on Uniswap because a couple of these exchanges, the liquidity dried up, right? So price discovery is flowing from Uniswap, the AMM, solution, to the centralized exchanges, not the other way around, right? Then if I make a trade here, I know exactly what the price is going to be after the trade's made. I can go into this derivatives exchange, take the other side of it, and pull it back up, right? And so that's what they did, and they started exploiting this, and they started, taking a large position over here, and then dumping, and then buying it back up, and like this is just like blatant market manipulation, right? But this is crypto. Like Uniswap doesn't have KYC. We don't have KYC. There's no way to know who these people are, right? Like maybe they're in our Discord or whatever, but like essentially you've got, this crazy situation where there's no way for you to, there's no recourse to like the legal system, right? Like either the system protects itself through, the software, or it doesn't, right? Like that's kind of it, right? And so what was really interesting though is that there was this debate again within the community of like, do we disable this, or do we like leave it open and see what happens? And we decided to disable it, but I was advocating for leaving it open because what started to happen is people started counter trading this trader in Uniswap, right? So like they would dump and then they would buy it back up, and so like it started to actually like liquidity, like that day, like liquidity went up like 100-fold or something like that, right? So like if you wanted to get out of your maker position that day, like that was the way to do it, right? You could have liquidated like a $1 million maker position with no slippage almost, right? If you'd been aware of what was going on that day, right? And now we disabled it and liquidity is back to nothing again, right? So when you look at that and you look at market dynamics, you kind of go, well, you almost would prefer that you just leave it open and let the market actually become more efficient and provide that liquidity, and liquidity will grow, but that wasn't kind of viable for us because it was too high risk, right? So the people decided, the community decided, let's actually disable this and we'll relook at it. And so it's one of the things that we now need to do, and we're in the process of doing. We're working with a team in New York that have a lot of experience in risk assessment and what have you, and coming up with a risk framework for these assets both, you know, when they're listed as well as like a continuous, because the problem was Maker looked fine when we listed it, right? And it was fine for 6 months, and then all of a sudden liquidity dried up over here, and all of a sudden you become, you know, at risk, right? So it can't just be, hey, let's list this. It has to be continuous monitoring as well.
Yeah, it's crazy because you know, especially with where the liquidity is in crypto markets right now, but also the fact that you have decentralized platforms, and it seems like you have to sometimes go through certain pains, you know, where these loopholes get exploited in order for the market to really come up with the better solution to advance the whole platform forward. While, you know, in a centralized environment, maybe, you know, it could be done easier, right? It could be done and fixed in an easier manner by maybe identifying those bad players, banning them and whatnot, right? But in decentralized platforms, it seems like, you know, sometimes, you know, you have to go through the pain to evolve and come up with a better structure, and eventually we'll get there. So, you know, I completely agree with that. Q, you had a question?
No, I didn't have a question. But I do admire Kain's honesty here, because he's not only in telling us about these processes, but him talking about how this problem did occur and here was the proposal and I said this and the community did a whole nother thing. So, however, I appreciate your honesty there, and you know, just allowing your community to also take part in this you know, process. So I think creating DAOs and governance, it's a large and complex issue, and I don't think we'll talk about it on this podcast any longer, because that could be, you know, 2 hours long.
For sure.
You know, so I don't want to get too far into it. I didn't really have a question, but when I was looking into Synthetix, it obviously is a complex system, and I'm glad that I have Dimitri here to kind of break it down and discuss with you, because it wouldn't have been as good a podcast without it. But one thing that did kind of connect with me was this like Synthetix stocks, because it allows maybe an ETH holder or someone who's involved in the Ethereum ecosystem to gain exposure to Apple or Tesla or all of these different stocks so easily. And you know, you said it there, no KYC. So I kind of like wanted to break down, how do you go about the regulations and the guidelines behind the traditional, you know, stock market and allowing these synthetic assets on the exchange?
Yeah, so that's a very good question. You know, and it's kind of an interesting question when we look at, you know, governance as well, right? Like shareholder governance is supposed to be a thing, right? Like, you know, you're not supposed to want synthetic exposure to Apple because you want to like show up at the, you know, annual meeting and advocate for like whatever you're advocating for, right? But we all know that that's like farcical, right? Like no one gives a shit about that, right? They just want price exposure. And so, you know, for the average person, having price exposure to, you know, Apple or Tesla or whatever is more than sufficient. And I mean, to your point around like the average ETH holder, I would actually take it a step further and say, you know, it's going to be the average anyone with a mobile phone and internet connection, right? Like once we've got really, you know, like Samsung obviously has released a phone with, you know, crypto wallet built in. Like this is coming, you know, Apple will absolutely do that at some point. You know, they've been somewhat adversarial with crypto companies, and you know, it could be somewhat disruptive, but Apple has a pretty good history of working out how to bring things in within the Apple ecosystem and extract value out of it. So I think that they'll work out a way, and I think you will find that like every single person in the world who has a mobile phone will have access to the Ethereum network, and by virtue of having access to Ethereum, you have access to, you know, equities and ETFs and you know, and all these kinds of instruments. So the question then is, okay, what does a regulator do about that, right? Now, regulators have already said that Ethereum is, you know, too decentralized to regulate. You know, the SEC has kind of said, okay, it's sufficiently decentralized that it's not a security, we'll let it go. But what does it look like when you have synthetic equities, you know, markets on Ethereum? You know, and what sort of regulatory scrutiny do we expect from that? And you know, the reality is that we don't know. You know, it's unclear. And Synthetix is kind of an interesting system as well, because there's no counterparty matching within Synthetix, right? Like we're not providing a trading venue for counterparties to trade against each other, right? It's essentially you own debt and you're just repricing it. It never leaves your wallet. It never, you know, you don't have to find someone who's willing to buy it at that price or whatever. You literally just have this right by holding this asset. And that's something that just, it's not going to be very easy to kind of, you know, work out how we deal with that.
Got it. So that's the key, that there's no actual asset being traded between two individuals.
I mean, it's a key, right? Like, I don't know, we don't know necessarily what the responsive regulator will be to that. And let's not forget, right? Like, okay, US equities, fine. But, what about Australian equities? What about, something on Hong Kong stock? Like, it's, you know, rich people in rich countries have access to brokerages that can get them access to equities anywhere in the world, right? The average person in the world does not have access to that. And so, this ability to kind of open this up. And the really interesting thing, I guess, as well, is like, okay, so you look at it and say, well, now there's just synthetic exposure to this asset, right? And so you've got all these synthetic assets floating around that, aren't providing value to the company, or aren't providing capital or whatever. It's just speculation. But when you actually take it all the way back to our conversation about hedging, actually that's not the case, right? Because someone needs to go and hedge it, and someone needs to go and buy, so all of a sudden you potentially open up this inflow of capital from all of these markets. So my argument would be it's actually a more efficient market. It's better for people to have access to equities anywhere in the world. It's crazier. It's certainly not going to make regulators super happy, but like it's arguably it makes sense. It's more efficient. It's definitely better. It's better for people. It's potentially better for the companies. It's better for the market in general. Maybe not so much better for the regulators.
Yeah, you kind of front ran me there on that statement. I'll be smiling, waiting to say it.
Sorry.
I can't wait until derivatives, like synthetics, will start impacting the spot market, in a way of like, hedgers coming in and impacting it in that way, which is fascinating, because you're opening up a new demand, from people that didn't have access to it. And that's how, it trickles down to the spot market through these, hedgers that come in and impact the spot market, on that side. So yeah, that I'm glad you brought that up. That's awesome. I wanted to ask you about, so when when are you planning, if you're still planning to have ETH as the collateral on your platform? Because I think I heard you mention that on some other interview where you were thinking of introducing ETH as the collateral. Maybe others that you guys are exploring to have in your platform as well.
Ether's collateral is kind of an interesting proposition, right? Because on one hand, the idea is that you don't have this, monolithic collateral pool, right? That's like all a single asset.
Right.
So you have, diversification of the collateral pool, which I think is beneficial. But then there's also the value capture thing, to go way back to the very, kind of early part of the interview when we're talking about how does SNX capture value, from the fees.
Right.
So if you start introducing alternative collateral types that also capture fees, then you potentially unwind some of the incentive alignment.
Mm-hmm.
So the way that we're thinking about Ether collateral is it's a way for someone to get into the system. They don't get access to the fees by providing Ether collateral, but what they do enable for themselves is an easy on-ramp to get access to this liquidity pool, right? So you can turn up with Ether rather than buying a synthetic asset like SUSD or synthetic Ether and having to trade your Ether or BTC or your crypto in order to get into the ecosystem. You can actually just borrow your way in, essentially, right? So you provide some collateral and you can borrow synths and you can start trading now. But the risk of the pool is still borne by the SNX holders. So they still get the rewards from providing the service. So it's a way of onboarding new people and diversifying the collateral pool and making, reducing the risk slightly. And we may add, synthetic Bitcoin as an option as well, right? So if you turn up and you've got, one of the wrapped coin solutions or, some Bitcoin on Ethereum solution, you may be able to present that as collateral and go straight into synthetic Bitcoin. At the moment, when you borrow synthetic Ether against Ether, it's not dollar denominated. So your borrowing is denominated in Ether, which means you can't use it for Ether leverage, right? Which was a deliberate decision that we made to not, lever up the Ether exposure, which is already very high in the pool. Yeah. But, in the future, we probably will allow that, right? We'll allow people to turn up with Ether and borrow dollar denominated and potentially get leverage, because we'll have leverage on the platform and we'll have, better hedging mechanisms in place.
Speaking of leverage, I do remember you also mentioning something about building a decentralized BitMEX. Now, are you still thinking about it? Where are you guys, on this subject?
I mean, this is what we're talking about, right? Like the stuff we're talking about now in terms of like spot markets and spot assets, that's all very much like phase zero, right? So eventually we will have synthetic futures, right? That are much more like BitMEX, perpetual contracts, things like that. And that's there's a lot of work in building that, and the sort of infrastructure and architecture that we're building out now will eventually support it, and it will just be another type of synthetic, smart contract essentially within the ecosystem that will tap into this pool. So it's definitely coming. It's just a question of when and some of the other things. If the front runners would stop front running, we'd have a bit more time to focus on leverage. So.
No, that's amazing. I love what you guys are doing, taking it one step at a time, in developing that technology and then tackling these issues as they come up. Right now, the required collateral is like 750%, right? That you require at the moment. And if things change in terms of volatility, this could be adjusted, obviously, right? Up or down, right? So that's always interesting to know if it's flexible or if it's fixed. But yeah, I mean, I think we went super deep. We discussed some really good topics. Anything else that Q that you have, or that we should cover before we wrap this up?
I'm still here. Let's jump into those DeFi baskets. That was super interesting. I wonder if you could kind of break down for someone who's just hearing about Synthetix what these DeFi baskets are, and then I think you guys may have just touched on it already. But if we hadn't hit on anything else that's going to come up in like the next year that you guys are kind of building into the platform, you can go ahead and talk about it as well.
So I think our roadmap has something like 48 distinct items on it. So we could be here for a few hours if we wanted to walk through that. It would take a long time. It's a bit like, I don't know if you guys have ever been to like a hotel or like a resort or something like that that's like half built, but they've opened it, like they've done like a pre-opening. I did that once, right? And it can be like quite confronting. It can be like a bit surprising. I went on vacation with my wife once, and I think we were going to the Philippines or something like that. And she was like, "Oh, we're going to stay at this place," and she organized it all. And so I turned up, and I was like, "What is going on?" There's like wires around here, and like this whole. And she was like, "Oh, it's like the pre-opening, right?" And I feel like I live inside of like pre-opening right now. Like everywhere, people turn up and they're like, wait, like, because they kind of think that it's built, right? Like you assume like it's there. It's like, so they turn up, they walk through the doors, and there's like cables everywhere and girders, and the ceiling's not done, and they're like, wait, I thought this thing was open for business. So it is a bit it can be a bit frustrating at times because there's still so much to do. And so people have this like kind of, and we probably just need to do a better job of communicating that like this is still a work in progress, and we've taken that approach. While it's obviously fairly high risk, we've tried to take this iterative approach because ultimately you won't know what the attack vectors are until you kind of get empirical data about it, right? And so in decentralized systems, it's sometimes hard to close these gaps. But ultimately, if you just base the kind of potential attack surface on what you theoretically assume versus like what practically people will do, you can kind of get it wrong. And so for us, it's this kind of continuous experiment of like seeing how people will try and extract value from the system and working out ways to close those loopholes. So there's a lot of stuff to do still.
Yeah, I think we just found the title of the episode, Synthetix, so still a work in progress. But no, I'm just I
can get people like climbing in the windows and like people climbing down in the roof and like coming into the hotel rooms, and you're like, oh, we should probably put a roof on that and stop them from camping out and squatting in our hotel. But so it's constant. It's just a constant battle to kind of build, make it more robust.
We see so much like, where in crypto, like you have these theories and projects that are coming out with new things, right? And everybody is loving to, speculate into how, saying that things are going to go to the moon. That's it. That's perfect. Like it sounds perfect on paper, but really like when it gets released, gets tested with the market, you start finding all these issues. And, I agree with you 100% that until you release and start working these products, in this industry, that's when you can start adapting, fixing a bunch of things. But I feel like a lot of people in crypto, they expect, things sounding great on paper right away. Like you mentioned, like MakerDAO sound amazing, right? But like, you guys are into some issues there. And like, so like adapting to those things is really what matters and gives you value. And you guys have been doing really well.
Yeah, thanks. I mean, it's kind of a startup. You asked at the beginning my history, right? Like I've been through a lot of failed startups, and the startup kind of ideology is like, put things out there, test the market, wait. We're actually in the process of hiring a couple of engineers, and one of those engineers worked for another project, and basically they went through like multiple iterations to try and like perfect this thing, and I think at times there can be this like desire to get it perfect before you show everyone, and that's a very it's a strong desire, but the reality is that what you think is perfect and what the market thinks is perfect, the distance can be vast. It could be a huge gulf. So and maybe uncrossable at times, right? So get stuff out there and see what breaks.
Yeah, absolutely, man. Well, this has been a good episode. This is honestly, I think Dimitri's going to start his own podcast after this, but I would love to hear like what other things besides maybe Synthetix, obviously, but maybe something that interests you besides the DeFi kind of movement that's happening in crypto right now. What other things in the crypto industry are happening that interest you?
Yeah, I mean, privacy I think is a huge thing, right? So there's a couple of privacy projects that are doing really well, like Tornado Cash is one of them, and I think that it is an area that's going to really proliferate. That said, we say, okay, it's outside of DeFi. Like, is it outside of DeFi? I don't know. I kind of feel like DeFi becomes somewhat all-encompassing, right? Like, we can't have financial transactions on Ethereum that are all public, right? Like, we had the earlier about like a negotiation of pricing, right? Like people won't do a transaction if it's a pricing negotiation. It's going to be publicly revealed what the price was paid for certain things, right? They want private information. So I think this idea of having private transactions is critical for DeFi to actually be able to kind of progress. So I think it's still kind of DeFi-ish, but it's also infrastructure. So I think the kind of development of that. The other thing that's super exciting that, talking about things not being priced in, I know I'm contradicting myself, but like, I really think that people have massively underestimated the impact of things like optimistic rollups. Those things are coming, and they're coming soon. And the UX of something that's running on optimistic rollups, which is basically just latency for us just kills us, right? All of a sudden you collapse that latency, and a user clicks a button and the transaction confirms like sub-second. It's a different ball game, right? You can have all, obviously there's a trust trade-off to an extent, but if the trust trade-off is not massive, it's going to change so many of things that we currently feel are clunky and make them just seamless and amazing. So I think that's something that that's coming and is super exciting, and it's going to happen this year. Like 100% this year, you will see major dApps that are using optimistic rollups or zero knowledge proofs, and are super fast, super easy to use, and just an amazing experience.
Yeah, I think.
Yeah,
you go ahead, Dima.
Go ahead. No, you go.
No, I was saying that I think people are starting to realize that. I mean, we're all here pushing mass adoption, and most people could care less about 100% security, and that's where you see things like scalability kind of taking over and kind of being in the forefront. But sorry for stepping in front of you there, Dima.
I was just going to say that we're big fans of privacy, tokens and zero proof knowledge. And if Mike Finch was here, he would also, say something about it, how he's a fan of it, and, how it's looking to, blow up soon. And it hasn't really blown up to the extent that we really should see in the market overall. But yeah, I mean, that's, it's been a really beautiful interview. I really love what you guys are doing. Good luck with everything. Before we let you go, we do have a question. Q, what is the last question that we have?
We have a book question, and you can't recommend your own book, but we want you to.
I honestly wouldn't. Don't worry.
All right. So if you could recommend one book, inside crypto, outside crypto, 10 years ago, yesterday, what book recommendation would you give the guys out there?
I would say Inadequate Equilibria. It's one of those books that I think when you read it, you're just like your whole perspective on reality just gets shifted, right? And you realize that all of these things that you sort of complain about and say like, oh, why, this is so dumb, right? Everyone's so dumb. Why is everyone so dumb? You realize that actually, it's this kind of weird situation where the equilibrium point is kind of shifted in a way that no one likes, but there's no one who's able to kind of shift it out. And so, crypto, I think, has the potential to be a lever that could shift a whole bunch of things in the world that we sort of look at and go, why does that work that way? And it works because of some thing that we don't really understand. I think crypto has the ability. It's one of those enabling technologies that could shift the equilibrium points in a whole bunch of things. And we're just starting to see the impact of that. So Inadequate Equilibria, I think, is something that, if you're looking for something to do in crypto or some inefficiency that could potentially be fixed, it will change your mindset and you'll start seeing things in a very different way. So one of my favorite books of all time, definitely highly recommend it.
Amazing, Ken. Thank you so much for coming on today. We appreciated the lively discussion. I hope you appreciate it as well, and we'll have you back on soon.
Yeah, I'll be on Dimitri's podcast next week, so check that out.
Sounds good.
Competitors. All right.
Awesome. All right. Thanks, guys. Talk soon.